Good afternoon, guys. This is the continuation of Alex report, Total Asset Turnover. The introduction to the DuPont analysis included an example of the total asset turnover ratio. This ratio provides a measure of how well the company manages its assets to generate sales. So the asset turnover ratio is measuring the efficiency of a company's assets to generate the revenue or sales. The higher this ratio's value, the more efficiently the company utilizes its assets. Because na-generate niya yung sales or revenue in an efficient way, kaya yung ratio's value niya is mataas. If mababa naman yung ratio value niya, yung company is hindi niya nagamit ng maayos yung isang assets, or siguro may internal problem sa isang company kaya yung ratios value niya is mababa. Asset turnover formula. To calculate asset turnover formula, net sales or revenue divide by average total assets. For example, suppose company ABC had total revenue of 10 billion at the end of its fiscal year. Its total assets were 3 billion at the beginning of the fiscal year and 5 billion at the end. The average total assets are 8 billion kasi 3 billion plus 5 billion is equals to 8 and divide by 2 kaya naging 4 billion siya. Its asset turnover ratio for the fiscal year is 2.5 because 10 billion. Yung 10 billion is yung net sales or revenue divide by 4 billion or ito yung average of total assets. Kaya yung asset turnover ratio niya is 2.5 billion. Operating cycle, working capital requirements. The operating cycle consists of three basic functions, yung production, sales, and collections. The length of the cycle depends on the respective efficiencies of conversion of raw materials, work in process, and finished goods into sales and accounts receivables into cash. It is the length of time to convert yung total net working capital or yung current assets is ililist sa current liabilities para ma-convert into cash. Purchasing, production, and distribution practices that lower the inventory turnover ratio increase the operating cycle. Working capital requirements can be defined as the difference between current operational requirements at current operational resources. Sa current operational requirements, ito yung mga inventories, accounts receivables, while sa current operational resources naman, dito nakapaloob yung accounts payable and accruals. Operational requirements and operational resources are spontaneous items as associated exclusively with the operating cycle like yung procurement, production, at sales. Cash conversion cycle is yung amount of time from the outflow of cash until it's recovered. Ito yung metric that shows the amount of time it takes a company to convert its investment into inventory to cash. The conversion cycle formula measures the amount of time and days it takes for a company to turn its resource inputs into cash. Cash conversion cycle formula is days sales outstanding plus days purchases and inventory minus days purchases and payables. Sa pag-calculate ng cash conversion cycle formula, yung days sales outstanding, days purchases and inventory, days purchases and payables is kailangan mo munang i-calculate para makuha mo yung cash conversion cycle. For instance, if you're calculating it for a quarter, you would need to use 90 days, and if you are calculating it for the entire year, you would use 365 days. To calculate your cash conversion cycle, you have to follow multiple steps. Step 1, calculate days of inventory outstanding. This is used to determine how many days it takes to turn the inventory into sales. The formula of days of inventory outstanding is average inventories over divide by COGS or cost of goods sold times 365 days. 365 days is yun yung ginamit dito sa example. On Cathy's income statement, her beginning inventory for 2019 was $10,000 and her ending inventory balance was $7,300. The COGS for the year was $50,000. So $10,000 plus 7,300 divide 2 is equals yung 8,650, or ito yung tinatawag na average inventory cost. Now, it's possible for Cathy to calculate her days of inventory outstanding. Ang average inventory niya is 8,650 divide yung COGS niya, which is 50,000, is equals to 173. 0.173 times 365 is equals to 63.14. So this means it takes Cathy approximately 63 days to turn her inventory into sales. Step 2. Calculate the DSO, or Days Sales Outstanding. This is an important metric on its own because it indicates the number of days it takes for you to collect on your accounts receivable balances after you make a sale. The formula of calculating days sales outstanding is average accounts receivable divided by total credit sales times 365, which is yung 365 is ito yung ginamit ko na para calculate ang DSO. Cathy's beginning accounts receivable balance in 2019 was $10,000 with an ending accounts receivable balance of $7,000. Both of these totals are available on her balance sheet. Now, Cathy needs to get her total credit sales for the year from her income statement, which is $100,000. With these numbers, Cathy can complete the DSO calculation. 8,500 yun yung average accounts receivable balance niya, kasi 10,000 plus 7,000 divide 2 is equals to 8,500. So 8,500 divide 100,000 times 365 is equals to 31.025. This means it takes Cathy an average of 31 days to get paid on an invoice. Step 3. Calculate the DPO, or the days payable, or days payables outstanding. This third step is to calculate the number of days it takes the business to pay its suppliers, creditors, and vendors. The formula of days outstanding is average accounts payable over divide by COG, or cost of goods sold, times 365. Cathy had a beginning accounts payable balance of $7,500 and then ending accounts payable balance of $8,100. Her cost of goods sold for the year was $50,000. This is the same amount that was used to calculate days inventory outstanding. Cathy can calculate the days payable outstanding as follows. 7,500 plus 8,100 divide 2 is equal to 7,800. So, ito yung average accounts payable balance niya. Tapos, $800 divide 50,000 of cost of goods is equals to 0.156. So, ang days payables outstanding is 150.156 times 365 is equals to 56.94. That means it takes Cathy an average of 57 days to pay her suppliers and vendors. And the last step is to calculate the cash conversion cycle. This is the last step, calculate the cash conversion cycle. To do this, add together the days inventory outstanding and days purchases and inventory minus days purchases and payables. In Cathy's examples, cash conversion cycle is equals to yung day sales outstanding niya is 63.14 plus 31.025 at yun yung days purchases and inventory niya minus days purchases and payables, which is 56.94, is equals to 37.25. So, ang cash conversion cycle niya ngayon is equals to 37.225. It means Cathy takes about 37 days to turn her inventory into cash. This information helps her assess how efficiently she is sa pagmamanage ng kanyang working capital. Free cash flow. Free cash flow is the cash that a company generates from its business operation after subtracting capital expenditure. Ito yung cash na maiiwan sa company after mabayaran lahat ng ginamit sa operation. It is important measurement since pinapakita dito kung gaano ka-efficient ay isang company sa pag-generate ng mga cash. To calculate free cash flow is equals to cash flow from operating activities minus cash expenditures. Sa pag-calculate kasi ng free cash flow, may tatlong way para makalculate mo to, using operating cash flow, using sales revenue, and using net operating profits. So, ang ginamit ko dito is using operating cash flow. For example, Macy's cash flow for the fiscal year ending 2019. Yung cash flow from operating activities niya is $1.608 at yung capital expenditures niya is $1.157. So, it means that Yung free cash flow niya is equals to $450 because cash flow from operating activities minus the capital expenditures is equals to 450. That's why yun yung nakalculate niya for the ending of 2019. Yun lang po. Thank you.